Welcome to the deep dive. Today, we're looking at something, well, a bit contradictory. Can a company completely change its business, get insiders to pour money in, and even get tagged strong buy, but still be um, basically a high-risk bet? We're digging into Digital Inc., ticker BTBT, to see what's really going on. Our mission, simple. We want to dissect this radical strategy shift they've made, really look at the management, their financial health, and figure out if there's any actual intrinsic value here from a value investor's point of view. And just a reminder, everything we talk about is based on public info available as of July 2nd, 2025.
Exactly, and that's what makes this one so interesting, right? You have these deep contradictions. It really pushes you to think about how traditional value investing even applies here. With such a fast change in the whole digital asset world, it's quite the puzzle.
It absolutely is. And for this deep dive, we're leaning heavily on a detailed report, the Deep Dive Analysis of Digital Inc., BTBT, a value investor's perspective. Now, before we dive in, a quick word from our sponsor. This deep dive, which actually focuses on a ticker requested by one of our premium members, is brought to you by Stock Analytics AI. For just $4.99 members, Stock Analytics AI members get priority access to deep dives on S&P 500 stocks. And listen, over the next few months, they are covering all of them, so members get first dibs. Plus, if you just want a one-off deep dive on a specific stock, you can drop them a super thanks. Okay, let's get into it. We've broken this down into two main parts, 7 chapters in total. Let's start unpacking this now with part 1. Chapter 1. Business analysis. Right, so to even start understanding Digital, you first have to grapple with this, what the source calls a radical strategic transformation, because honestly, it makes everything else kind of complicated.
You're absolutely right. The heart of it is what they call the strategic pivot, from diversified miner to Ethereum pure play. So on June 25th, 2025, they just announced a massive shift. They're becoming a pure play Ethereum staking and treasury company. Think about that. They're selling off their Bitcoin mining gear, even converting their existing Bitcoin into Ether. It's a complete U-turn from their old business.
Wow, okay, so what does that actually involve day to day?
Two main things. First, Ethereum treasury. This just means buying and holding ETH as their main asset, kind of like what MicroStrategy does with Bitcoin. Second, institutional staking. This is where they try to make money, generate yield on the ETH they hold. They're claiming they have one of the biggest institutional staking setups globally. The idea is to be like a regulated way for big players to get exposure to ETH yield.
Okay, but they're not doing all the staking themselves, are they? They're using partners. What does that mean risk-wise?
Yeah, exactly. They rely heavily on partners. Figment Inc. is a big one for the actual staking. They had something like over 21,000 ETH staked with them back in March 2025. And then for security, they use institutional custodians like Fireblocks and Cactus Custody. Now, these are well-known names, sure, but it definitely introduces counterparty risk if Figment or Fireblocks has a problem.
Digital has a problem.
Precisely. Their operations could take a hit. What's also interesting is how they've tied this pivot to regulation in the U.S. They specifically mentioned the Guiding and Establishing National Innovation for U.S. Stablecoins Act of 2025, the Genius Act. It feels like a calculated bet,
Yeah.
trying to get ahead of the curve, position themselves within this potential new legal framework. But here's the real kicker, especially if you're thinking like a value investor. This isn't diversification at all. It's a massive concentration of risk. They're ditching established moneymakers, Bitcoin mining, their HPC services to go all in on one asset, Ethereum, and a strategy, staking, that's frankly pretty low margin.
Right.
Just look at Q1 2025 numbers. Their HPC and cloud services, that was the growth engine, pulled in $14.8 million, up 84% year over year. Bitcoin mining was $7.8 million. And ETH staking, just $0.6 million.
Wow.
So this whole pivot, it pushes them much closer to being just a speculative holding vehicle for ETH rather than a business that consistently generates revenue.
That's a huge red flag right there. And if that wasn't complicated enough, there's this really surprising spin-off. The part of the business many thought was their best bet.
Oh yeah, this part is really strange. It's the white fiber anomaly, the HPC spinoff. See, before this big ETH pivot, Digital was actually building out this HPC business, white fiber, pretty aggressively. They were providing GPU cloud services, colocation, mainly for AI companies. Then, like we just said, this was their main revenue driver, their growth story. They even had big multi-year deals with customers like Boostroid and Cerebras Systems.
So the part that was actually growing.
Exactly, the part that was growing fast. And then, right alongside this massive pivot to Ethereum, they announced White Fiber has confidentially filed for its own IPO. They're separating the businesses.
That just seems backwards.
It's a total paradox. They're ditching their biggest, fastest-growing revenue source. Remember, $14.8 million from HPC in Q1 versus only $0.6 million from ETH staking to double down on this brand-new, high-risk ETH thing. Now, okay, the HPC market is super competitive. You've got AWS, Azure, Google Cloud, Core, Weave. BitDigital was tiny compared to them.
Yep.
But still, white fiber was their growth story. It makes you ask the obvious question. Why on earth abandon a proven growing business for what's currently your smallest and most speculative bet?
So after ditching mining and spinning off HPC, what's left? What's their competitive edge now? Is there anything proprietary, or are they just, another face in the crypto crowd?
That really gets to the heart of competitive moat and value proposition. Their new pitch is basically, we offer secure, scalable, compliant access to Ethereum yield. They want to be the easy, publicly traded way for institutions to get ETH exposure. But it's getting crowded fast. You've got other public companies doing similar things. SharpLink Gaming, BitMine Immersion Technologies. They're building ETH treasuries too. SharpLink actually just became the biggest public ETH holder. And while, yeah, there are barriers to doing institutional staking, right? You need tech know-how, capital. Series security, BitDigital, as we said, relies a lot on partners for that. So their moat, their advantage, it isn't really tech. It's basically just being listed on the NASDAQ and being a U.S.-regulated company.
That sounds thin.
It is. It's shallow, easily copied. What happens if bigger banks start offering similar ETH products? Or if regulations change and make it easier for institutions to just hold ETH directly, that main differentiator could just vanish. Value investors look for durable advantages, things that last. A moat based purely on current compliance in a fast-changing regulatory space, that's fragile.
Which leads us perfectly into Chapter 2, management evaluation. Because, yeah, leadership quality and integrity are just crucial for value investing. But with BitDigital, the history makes evaluating them pretty tricky.
Definitely. Let's look at the leadership profile and experience. The CEO is Samir Tabar. He came on in March 2023. He's got a solid background, finance, Law Bank of America, SCAD and ARPS. He also co-founded Fluidity, which made the AirSwap DebtX, so he does have real crypto chops.
Yeah.
But then you have Huang. He's the CFO and a director, been there since October 2019. His tenure is much longer and, well, more complicated. He's seen the company through that whole transition from Golden Bull, the failed P2P lender.
Right, the controversial stuff.
The J Capital short seller report, all these different pivots. He's been the constant through all that turmoil.
So the CFO has really ridden the waves. And speaking of pivots, didn't they hire key people specifically for that HPC business they're now spinning off? What's that about?
That's another odd point. Exactly. Back in September 2024, they brought in Benjamin Lamson as head of revenue, Tom Sanfilippo as CTO. Both came from Paperspace, a known HPC player. They were clearly hired to build out White Fiber, the business that's now being spun off.
Yeah.
It suggests either the ETH pivot was a very sudden decision, or maybe they always planned to build and spin off White Fiber. Either way, it points to what the source calls strategic churn. It's just really hard to assess their long-term vision or consistency when things change so drastically. That's unsettling if you're trying to invest for the long haul.
Okay, let's unpack their capital allocation. That recent stock offering, that feels like a really big deal, especially for existing shareholders.
It absolutely is. Under capital allocation and shareholder alignment, management's recent moves are starkly contradictory. They took the full $162.9 million net proceeds from that June 2025 public offering and earmarked it all for buying Ethereum. That is an incredibly concentrated bet, putting all that new capital into one single, highly volatile asset.
But didn't the insiders buy into that offering? I remember seeing that.
Yes, and that's the other side of the coin. There was a strong signal of personal conviction. CEO Sam Tebar bought 750,000 shares. That's $1.5 million. Director Brock Pierce bought 500,000 shares, $1.0 million, both at the $2 offering price. Those are significant personal investments.
So you've got insiders putting skin in the game, which normally looks good, but then there's this massive dilution hitting everyone else. How do you square that circle as an investor?
That's the fundamental dichotomy, isn't it? On one hand, you have enormous shareholder dilution. That offering spat out 86.25 million new shares. That diluted existing shareholders by over 40%. Your slice of the potential future earnings just got way smaller. Then yeah, you have this strong insider buying. The message from them is, we believe this pivot will create so much value it'll outweigh the dilution. But for a value investor, looking at the company's track record, this unproven new strategy, you have to be deeply skeptical. Can even million-dollar insider buys justify diluting everyone else so heavily for such a speculative venture? Especially when you consider the CEO's pay mail. Sam Tabor's total compensation was reported at $4.82 million, mostly bonuses and stock, at a company that's not profitable. It's a tough sell.
And to really get the full picture, you have to look at the past, right? The governance history here is, well, it's something else.
It really is.
Yeah.
Governance in historical context reveals a pretty troubled past. The company used to be Golden Bull Ltd., a P2P lender in China. That business got shut down by authorities for illegal fundraising. Former execs even faced criminal charges. That's not a great starting point.
No kidding.
Then, after they pivoted to Bitcoin mining, January 2021, the short seller J Capital Research hit them hard. Accused them of being a fake cryptocurrency business, said their miners in China didn't even exist. Bit Digital denied it all, fought back, but it still led to a securities class action lawsuit. They settled that for $2.1 million in March 2023. So you see this pattern, right? From a failed, scandal-ridden business to one accused of being a sham, to now this latest radical pivot. It suggests maybe a history of reactive, opportunistic moves driven by narratives rather than steady, methodical business building.
And the CFO, or Kwang, was there through all of that.
Yep. He's the thread connecting all these different tumultuous phases. One positive governance note, though. They did recently switch from being a foreign private issuer to a U.S. domestic filer. That means stricter SEC reporting, quarterly 10Qs, annual 10Ks. More transparency is good, but it doesn't exactly wipe the slate clean.
Okay, let's move to Chapter 3, financial analysis. For value investors, this is where the rubber meets the road. The numbers often tell a very different story than the strategic narrative.
Especially with Bit Digital.
They certainly do. Under income statement analysis, a tale of two strategies, the revenue picture is just incredibly volatile. Shot up to $96.1 million in 2021, then crashed to $32.3 million in 2022, then bounced back to $108.1 million in 2024. But, and this is crucial, that 2024 recovery was almost entirely driven by the HPC cloud services segment, the part they're now spinning off, not Bitcoin mining.
So the growth came from the part they're getting rid of.
Pretty much. And profitability. It's been elusive, to say the least. They lost a massive $105.3 million in 2022. Now, they reported a $28.3 million profit in 2024, but that figure is really misleading. It was mostly due to a $55.7 million pre-tax gain on their digital asset holdings, basically. The price of their crypto went up. It wasn't profit from actually doing business.
Mark-to-market gains. Exactly. And Q1 2025 swung right back to a $57.7 million net loss, which included a $49.2 million mark-to-market loss on those same digital assets. Their reported bottom line is just completely driven by crypto price swings, not operational efficiency. If you look at their actual operations, they lost $28.1 million operationally in FY 2024. And in Q1 2025 alone, operating expenses were $64.7 million. This business doesn't make money from its operations. It relies on crypto going up or raising more cash.
Okay, so the income statement is shaky. What about the balance sheet? Does it look stronger, especially now they're loading up on Ethereum?
Well, let's look at balance sheet strength and transformation. Before the big offering, as of March 31st, 2025, they had about $57.6 million in cash, and total liquidity, including crypto, was around $141.4 million. And they do make a point of having no debt, which is definitely a positive. But that June offering completely changed the picture. They raised $162.9 million net, specifically to buy ETH. So yes, the balance sheet will show a huge jump in digital assets.
So more assets. Does that mean the stock is cheap relative to its assets, like price to book?
That's where it gets tricky. In Q1 2025, their book value per share was about $2.01. The stock was trading around $2.03 to $2.31 then. So the price to book ratio was roughly 1.0. Superficially, that might look cheap. But here's the problem for a value investor seeking a margin of safety. That book value is becoming overwhelmingly dominated by one single, highly speculative asset, Ethereum. It's volatile. Its value can change dramatically overnight.
Right. It's not like machinery or real estate.
Exactly. So if the crypto market tanks, a huge chunk of that book value just evaporates. The margin of safety isn't a solid floor based on productive assets. It's completely tied to crypto market sentiment. It offers very little real protection if things go south.
Ultimately, for a value investor, it always comes back to cash flow and what the business is truly worth. What's the story there? Does this company actually generate cash?
Looking at cash flow and intrinsic value estimation, the pattern is, well, troubling. The core business just isn't self-sustaining. In Q1 2025, sure, cash flow from operations was positive $17.4 million. But that was completely swamped by a negative $65.0 million outflow for investing activities, mostly buying assets, presumably crypto. So free cash flow was negative $25.4 million for just that one quarter.
So where does the money come from?
Financing activities, selling stock. They raised $257 million in FY 2024, another $163 million from the offering in June 2025. This is textbook for a company that can't fund itself. They're paying for these speculative ETH purchases by taking money from new shareholders and diluting existing ones. And with ETH staking yields reported around, 3.2% annually, it's highly unlikely that generates enough cash to cover their operating expenses and future growth, which means
more dilution down the road.
Very likely. So trying to value this using a traditional discounted cash flow, a DCF model, it's basically futile. Future cash flows depend entirely on the price of ETH and staking yields, which are anyone's guess. The only sensible approach is asset-based. If you take their Q1 equity, $417.04, and add the offering proceeds, $162.09, you get pro forma equity around $580.03. Divide that by the new higher share count, around 293.9 naming shares, and you get a new tangible book value per share of about $197.
Okay, $1.97 book value. And the stock was trading
Around $2.31 on July 1st, so it's actually trading at a premium to this new, highly volatile book value.
So even that cheap book value argument doesn't really hold up. What about other key financial ratios? Anything positive stand out?
Not really. From an operational standpoint, price book's about 1.04, looks cheap, but we know the book value quality is low. Return on assets, ROA, is negative 25.72%, hugely inefficient. Return on equity, ROA, is negative. They're destroying equity value. Return on invested capital, ROIC, is a shocking negative 28.97%. They're earning way, way less than their capital cost. The only real positives are short-term liquidity. The current ratio is strong at 390, and the fact they have zero debt. That's significant. But those don't make up for the fundamental lack of profitability and the reliance on external funding.
That wraps up part one. Wow. We've got a company making a massive risky pivot away from its growth engine, a checkered past, and financials that scream speculation, not investment. Coming up in part two, we'll see how the market's reacting, who owns this thing, dive deep into all the risks, and then deliver our final verdict. Welcome back to the deep dive, part two of our analysis of Bit Digital. Let's jump straight into chapter 4. Market sentiment and valuation. Okay, this is where it gets really interesting because you see this huge gap between Wall Street analyst ratings and, well, how the market actually seems to feel.
Absolutely. It's quite the contrast. Under analyst ratings and price targets, the Wall Street analysts covering BTBT are uniformly bullish.
Yeah.
The average brokerage recommendation is 1.00. That means strong buy across the board from the 5 firms covering it. And their price targets, just as optimistic. The average target is somewhere between $5.90 and $6.25, with one firm, H.C. Wainwright, going as high as $7. From a stock price around $2.19, that implies like 169% upside. Wainwright's thesis seems based on both the white fiber spinoff potential and the ETH pivot.
That's incredibly optimistic. Is everyone buying that story, though? Any dissenting views?
Well, not directly from the covering analysts, but other indicators aren't so rosy. The Zacks rank, for instance, which focuses heavily on earnings estimate revisions, puts Bit Digital at a hold or even a sell. They cite growing pessimism about earnings and downward revisions. So some like the story, but the numbers guys are getting nervous.
Okay, so the analysts covering it are bullish, but the market might be more skeptical. What about the bears? Is anyone actively betting against BTBT?
Oh, definitely. Under the bear thesis, short interest and market reaction. The standout number is the short interest. It's exceptionally high. One source pegged it at 21.68% of the public float in late June 2025. Others show slightly lower, maybe 9.7% to 16.3%, but even those are very elevated levels.
Wow, that's significant.
It really is. It means a large chunk of the market is actively betting the price will go down. It signals widespread doubt about this new strategy, about management, about the future prospects, and you saw that doubt play out immediately after the pivot and the offering were announced. The market reaction was unequivocally negative. June 26th, the stock plunged 15.3%. Over 2 days, it fell more than 22%. That's investors voting with their feet, clearly uneasy about the dilution and the massive risk involved.
And technically, looking at the charts, where does it stand now? Is it showing strength, weakness?
In terms of technical posture, as of early July, the picture was pretty bearish. The price, around $2.31, was below its 200-day simple moving average that's generally seen as a negative long-term signal. It was trading near its 50-day SMA, suggesting maybe some short-term consolidation, trying to find a floor, perhaps. But the really striking technical feature is the volatility. Its beta is reported at 5.25. That's insane. It means the stock is theoretically over 5 times more volatile than the overall market. This is not a stock for anyone with low risk tolerance. It's a wild ride.
Definitely not for the faint of heart. Okay, let's move to chapter 5. Ownership structure. Who actually owns this company? And how aligned are their interests, especially after that huge stock offering?
Right, looking at institutional and insider holdings, institutions hold a decent chunk, around 38.36% according to the report. That's over 250 institutions holding more than 80 million shares. See some big names. BlackRock apparently increased its stake recently. Invesco reduced theirs. Interestingly, Citadel and Bank of America showed huge percentage increases in their holdings. That might be more indicative of trading activity around the volatility than long-term investment conviction, though.
And what about insiders? We talked about the recent buys.
Exactly. Insider ownership was historically very low, like 0.5%. But that's changed with the offering. CEO Sam Tamabar now holds over 2.1 million shares. Director Brock Pierce has around 580,000. Now, even with those big personal investments, their combined ownership is still pretty small relative to the total new share count, maybe around 0.9%. But the buys themselves are definitely a statement.
Those insider buys are a strong signal, no doubt. But given everything else, the history, the massive dilution, how much weight should an investor really give those buys versus the broader red flags?
That's the critical question under shareholder base and dilution. That June 2025 offering was the single most significant event recently impacting ownership, issuing 86.25 million new shares, increasing the total shares by over 40%. For a value investor who thinks the stock is owning a piece of the actual business, that's just profoundly negative. Your claim on any future earnings gets drastically deleted. The company needs to create an extraordinary amount of value just to get the per-share metrics back to where they were before the offering. It really signals that management sees the stock primarily as, well, currency to fund their ambitions, maybe with less immediate concern for the impact on existing owners. So, yes, insider buying is positive, but it has to be weighed very heavily against that massive dilution.
Okay, that brings us to Chapter 6, Risk Analysis. Understanding risk is paramount for any investment, but especially here. It feels like there are layers upon layers of risk with Bit Digital.
There really are. Let's start with strategic and execution risks. The company's entire future now hangs on this unproven pure-play ETH strategy. It's not a typical business. It's fundamentally a speculative bet on ETH's price appreciating. There's huge execution risk just in managing this transition, selling off old assets, and running this ETH treasury effectively. And this leads directly to severe concentration risk. Everything is tied to one asset class. If ETH enters a prolonged bear market, or if there's a major technical glitch in staking protocols,
It could be catastrophic.
it could be. Then there's the white fiber spinoff risk. That IPO might not happen, or it might not be well received. A failure there could hurt the parent company's stock price and its ability to get cash from that asset.
Okay, those are strategic risks. What about the financial side?
Under financial and market risks, the number one risk is simply digital asset volatility. The company's book value, its liquidity, any potential future profit, it's all directly tied to the wild swings in Ethereum's price. Then, as we've hammered home, shareholder dilution. They have a clear history of funding themselves by issuing stock. That recent 40% plus dilution, probably not the last time. Future cash needs will almost certainly mean more shares issued, constantly eroding value for existing holders. And finally, profitability and cash burn. The core model, as it stands, doesn't make money or generate positive free cash flow consistently. They burn through cash and rely on crypto appreciation or financing to keep going. There's just no clear path to sustainable operational profitability here.
And we can't forget the bigger picture, right? Regulation, the economy.
Absolutely. For regulatory and macroeconomic risks, their whole strategy hinges on crypto regulation in the U.S. evolving favorably. Those proposed acts, Genius and Clarity, are still up in the air if regulations shift the wrong way.
It could pull the rug out from under them.
It really could undermine their entire value proposition. Then you have interest rates and inflation. Higher rates make safe investments look better, potentially pulling money away from speculative assets like crypto. And while some hoped crypto would hedge inflation, recently it's tracked risk assets pretty closely, falling when central banks tighten policy. Lastly, maybe less direct now, but tariffs and supply chain could still matter. If they need future hardware for anything, U.S. tariffs on tech from Asia, sometimes 15–25%, could raise costs.
And finally, given that colorful history we discussed, what about governance and just plain reputation?
These are significant under-governance and reputational risks. That historical precedent, the Golden Bull scandal, the J Capital short report, the lawsuit, it creates a real reputational overhang. It raises questions about credibility and trust right from the start. And the pattern of pivots, these constant drastic shifts in strategy, it suggests perhaps a lack of a clear long-term vision. Maybe more like opportunistic narrative-driven moves that haven't actually delivered sustainable value for shareholders over time.
Which brings us to the final chapter. Chapter 7, Final Conclusion and Value Investing Thesis. Okay, let's synthesize all of this. What's the bottom line after digging through everything?
Well, when you pull it all together for the synthesis of findings, Bit Digital is a really mixed bag. On the surface, yeah, there are some positives that might catch your eye. Stock trading near book value, no debt, good short-term cash, those recent insider buys. But if you put on your traditional value investor hat, the deeper analysis reveals really profound flaws. The business itself. They've abandoned diversification for a super high-risk, unproven, speculative strategy tied completely to one volatile asset. It feels less like a business, more like a publicly traded holding vehicle for Ethereum management. Despite the CEO's experience and the insider buys, the history is problematic failed ventures, serious allegations, pivots that destroyed value. Credibility is definitely a question mark. The financials, structurally unprofitable, burns cash, relies on diluting shareholders. That book value anchor is volatile and offers no real margin of safety. And the risks, just exceptionally high across the board, strategic, financial, regulatory, governance.
So after weighing all that, what is the final verdict from a value perspective? Is this an investment or something else entirely?
For the value investing verdict, let's go back to basics, like Benjamin Graham. First, is it an investment or a speculation? Graham said an investment needs thorough analysis promising safety of principal and an adequate return. Bit Digital's future depends almost entirely on ETH's price. Its business doesn't generate predictable earnings. Buying the stock, therefore, is fundamentally a speculation on the price of ETH, not an investment in an operating business.
Okay. And that margin of safety.
Is there a margin of safety? That $1.97 tangible book value per share. It's illusory. It's not backed by stable productive assets. It's a snapshot of volatile crypto holdings. A drop in ETH price could wipe it out instantly. The true margin of safety is negligible, maybe even non-existent. And finally, is management trustworthy and capable? The Golden Bull history, J Capital, the constant pivots, they cast a very long shadow. Insider buying is noted, yes, but it just doesn't overcome that historical pattern of questionable choices and value distribution. So the final conclusion is pretty direct. As of July 2, 2025, Bit Digital, Inc., BTBT, simply does not qualify as a suitable investment for a prudent, risk-aware value investor. It is fundamentally a high-risk speculation. The decision to bet the entire company on ETH, funded by massive dilution, the troubled history, the lack of profits, the flimsy margin of safety, it all places BTBT firmly outside the realm of sound value investing. It's pure market speculation.
Wow. That was quite the deep dive. Thanks for walking us through that complexity. And for you listening, what stands out to you, Bo, about this analysis? This really makes you think, doesn't it? In this increasingly digital world, where does value actually reside when a company's whole existence seems tied not to steady earnings from a real business, but to the daily fluctuations of a single digital asset price? What does that mean for how we even define investment going forward? Something to ponder. If you found this deep dive valuable, remember you can get more analyses like this by checking out Stock Analytics AI. Members pay just €4.99 a month for priority deep dives on S&P 500 stocks, and they're covering all of them in the coming months. Find out more at stockanalyticsai.com. And just a quick reminder, all the research and analysis shared today, including that detailed underlying report, was generated with the help of advanced AI. That's what allows us to cover this much ground with this level of depth for you. Until next time, stay curious and keep diving deep.